Can you break down different types of mortgages a listener may get, and then a brief summation of what they are and why someone would maybe choose one over the other?
Sure. There are a lot of different mortgage types, but sort of like TLDR, almost everyone gets a conventional loan. They are like a conventional 30-year mortgage is by far the most common home loan type in the United States. It's something like 97% of the purchase loan market. So conventional loans are really common. They're sort of hard to explain because they're just like, it's the boring regular one. You can say what it's not, but it's hard to say kind of what it is. These are loans that mortgage lenders make. They're packaged and resold to Fannie Mae and Freddie Mac, who set standards around lending. And so they can have potentially stricter qualifications because of that, need to be resold to these government-sponsored enterprises. But if you do qualify, down payment amounts are as low as 3%, and they tend to have attractive interest rates. And so, there are a lot of reasons why conventional loans are the most popular, in addition to just like their sort of default. Like if a lender offers mortgages, they definitely offer conventional loans. It's just, that's kind of how it is. There are a bunch of different options of government-backed loans, though, that, depending on your priorities and your background and where you're looking to buy might work for you. FHA loans are backed by the Federal Housing Administration. And so because they have that assurance of this government agency backing them up, the lending standards can be potentially like a little bit more lenient. It's not always the case, since even though, HUD sets the guidelines, individual mortgage lenders get to say, like, we'll lend to you or not. But in theory, you can qualify for an FHA loan with a lower credit score. And depending on your credit score, you can potentially make a down payment as low as 3.5%. VA loans are backed by the Department of Veterans Affairs. So these loans have excellent terms. There's no down payment required. There's no mortgage insurance required, but they are not open to everybody. You need to be a current or former service member or a spouse. So, if you have a military affiliation, these could be a really good option. But if you don't, no one's probably going to like enlist just to get a VA loan. There are other choices out there. Right. Another one that's pretty uncommon, but I think mostly because a lot of people don't know about it and they can be a little bit harder to find. Not a ton of lenders offer them. The USDA, the U.S. Department of Agriculture, also does home loans. So they insure some home loans, and then they actually like give some home loans that are made directly by them. And they generally have geographic requirements that it needs to be in a rural area. But like if you use the zip code lookup on their site, you might be surprised what qualifies as a rural area. You can be pretty suburban or exurban, and it'll be like, yeah, it's a rural area. That counts. They can also have income restrictions depending on the type of loan that you're looking for. And then I would say the other sort of biggest type to know about, just that are out there, are jumbo loans. They're pretty much what they sound like. So Fannie Mae and Freddie Mac set limits on conventional loan sizes. If for whatever reason you need a larger loan than that, either because you're, just purchasing a really expensive property, or like you're in a place where purchasing a really expensive property is your option, regardless of its size, you might need a loan that is bigger than their underwriting standards. And so then you need to look for a lender who will do a jumbo loan. There's stricter lending standards for that, just because like it's a lot of money to deal with. And they usually ask for a bigger down payment. It varies. There's not like a rule, but it's generally more like a 10% down payment.
Okay, so can we break down even further for a listener who's like, I've heard what like a conventional loan means, but when we say a conventional loan, right, you and I know 30 years, but can we break down what that means? Like, so if you buy a house today, what does that process look like with a conventional loan?
Well, so one thing to know, so 30-year conventional is the most common, but it doesn't have to be a 30-year loan to be a conventional loan. 30 years is the most common term just because like it's generally a loan for a very large amount of money, right? You're buying a house. And so splitting it out over the longest possible period of time. Like right now in the United States, 30 years is the longest term you can get, and it's what most people go for. But you can, depending on the lender and depending on what you need, you'll see 20-year, you'll see 15-year, you'll even see 10-year.
My parents did 15 on their house. I remember them telling me that because they tried to pay it off sooner. They either, I think, started with a 30 and then refinanced, I think, to a 15, or they started right off the bat at 15 and we're just like, you know what, we're going to try to pay this off as soon as we can.
Yeah. I mean, depending on your priorities, particularly also like if you're older and you're looking toward retirement, you might really be prioritizing like not having a mortgage once you're retired, which I totally get that. That makes sense. So there are different reasons that you might want to do different things in terms of choosing your loan's term. But in general, 30-year conventional is by far the most common. In terms of like steps to getting a mortgage. So for me, the first thing would be really backtracking to, you've decided that you want to become a homeowner, right? You've decided that that's in your future, that's part of your plan. And it's not necessarily right now. It's in like a year or two or even 5. That's a really good place to get started, because before you're like taking it to that level of, I'm looking at houses and I'm talking to lenders and this and that, you want to make sure that your financial house is in order, like your metaphorical financial house, right? So if you've got anything going on your credit reports, if there's anything that you can if there's something incorrect in your credit reports that you need to fix, if there's something that you can improve, do it. Go ahead and do it. If you've got debts that you can pay down, go for it if that's possible. Try not to take on new debt. Like if you finish paying off your car, just keep driving it maybe instead of getting a new one. Try to avoid opening new lines of credit. Like really just kind of get yourself in shape where then when you're actually going to a lender, you're a really well-qualified candidate. And, you're someone where they're like, I want to lend her money. So that's sort of your ideal scenario, because when you are ready to start looking at homes, your first step, and I'm sorry, because I know like looking at homes is really fun. Like not even in person, just like recreational online home browsing.
That's been my hobby / activity during quarantine for the past 2 years.
Right. Yeah. I mean,
sent Zillow listings back and forth to each
exactly.
other, especially for the $10 million houses we cannot afford. It's just like very exciting.
Oh yeah. No, it's fun to creep on people's houses. Right. So I am sorry that this is not the next step. The next step when you are really serious and you're actually going to buy a home is to start talking to lenders and look into mortgage pre-approval. And that hasn't always been the case. It used to be like once upon a time, yes, you would go and look at a house and be like, I like this. Now I'm going to figure out the money. These days, all the money stuff really needs to be kind of sorted and settled before you even start looking. A lot of times, real estate agents won't take you to view houses if you don't have a pre-approval in hand. Sometimes sellers and sellers agents will ask for that as well. If you're a financed buyer as opposed to a cash buyer, they want to see proof that, you could be able to buy their home. So
and it's happening so quickly now too, right? That's the other thing, because I've like started to tiptoe into kind of like talking to a realtor, and he's sending me listings and I haven't done any of the paperwork yet because I'm not super serious yet. But like in that conversation, he's like, okay, if we're buying, like you need to have, because I live in Seattle, like you need to have your stuff together, because if you like a house, you have to make an offer on it the moment you like it. And then you'll have to fight 6 other people for it. But like, that's the idea. So if you don't have all your paperwork together and you're spending at least another, I guess, week at the best, in the best case scenario, getting all of that together, you've lost the house easily.
Yeah. You want to have that pre-approval like in hand, ready to go to say like, yes, hello, home seller. I am making you this offer and I am good for it, right? Like this sale, should you accept my offer, this sale would close. I am qualified to borrow at least this much money. And you can get a pre-approval from more than one lender. It often makes sense to get pre-approvals from more than one lender because, you're not seeing the interest rate that you will be offered or that you will get when you actually apply, but you'll have an idea kind of relative to one another, what the interest rates might be. And also like different lenders might qualify you to borrow different amounts, right? With that pre-approval. So some of them might be like you look a little risky to me. Like, here's what you can borrow. And another one might be like, oh no, like I understand what's going on with you. Here's this. You can borrow more. So, it's worthwhile to do that. And also, another thing that's important to know with pre-approval is that you're giving the lender, not free reign to kind of go through your stuff, but you are giving them some permission to look through your finances and actually like verify the things that you're telling them. So this is different than like if you see mortgage pre-qualification, where it's like, oh, pre-qualify in minutes. Yes, you can pre-qualify in minutes because you're just typing in some numbers and then they're spitting a number back at you. But, you could have put in whatever numbers you want. No one's checking. So a pre-qualification isn't really meaningful. With a pre-approval, you're actually showing proof of income. They've got your social security number. They're going to do a hard credit pull. And so that is going to ding your credit score. But if you do all of them within like 14 to like on the outside, like 45 days, but really kind of once you're on a roll with doing it, it's like, oh, bing, bang, boom, just keep doing pre-approval applications. The credit bureaus can tell that you're shopping. And so they'll just count it as one inquiry instead of like, 5 inquiries. So, clump it together and that's helpful for you.